Hello, everyone. This is John Muntz with Dealer's Edge. I want to welcome you all to our ongoing series of workshop summaries where we take one of our full-length online workshops and produce a shortened video summary of the material provided. We typically host 3 to 4 full-length webinars a month that usually run about an hour's time. In case you haven't heard of us, Dealer's Edge is a firm dedicated to informing dealers and dealership management on topics relevant to your bottom line. We are always producing new content via our online workshops, webinars, manuals, books, and summary. For this summary, we are talking about exceptionally successful parts managers with Fixed Ops and Parts Guru Chuck Hartley. Dealer's Edge members have access to the full 1-hour workshop as well as the executive summary in PDF format, which is what is being read here, not to mention hundreds of other topics targeted to dealership owners and managers. Please remember to like, comment, and subscribe to stay informed of new releases. Also, if you have ideas about auto dealership topics you would like us to cover, please enter them in the comments below. So, all that aside, let's get into it.
Dealer's Edge Executive Summary Checklists for the Exceptional Successful Parts Manager. Getting maximum return for your parts department is a question of reliable processes for delivering correct parts when needed, plus careful and effective management to prevent inventory obsolescence. It is even more so in the age of COVID, as broken supply chains and labor shortages exacerbate parts availability and cause prices to increase. So faced with speed bumps ahead, what's a parts manager to do to ensure that the dealership gets an acceptable ROI on their parts investment? Chuck Hartley, president of Parts Edge Inc., www.partsedge.com, joined us for an online workshop to share his thoughts on how checklists and reports can be used to deliver an exceptional parts department. Chuck has 30 years of experience in the automotive parts industry, with 20 in the dealership parts environment. For 15 years, Chuck ran one of the largest Chrysler parts operations in Southern California and finished out his time as a fixed operations director for the same dealership before moving on to Parts Edge as a full-time venture. Chuck was also co-founder and president of the Mopar Masters Parts Guild, a national guild consisting of the top Chrysler parts managers in the country. Since forming Parts Edge Inc., Chuck has participated and spoken in front of many workshops, seminars, 20 groups, and dealer associations. This report is a summary of Chuck's comments and suggestions. Inventory is money sitting around in another form. Rhonda Adams, USA Today columnist and small business advocate. In the workshop, Chuck Hartley catalogs just what highly effective parts managers do every day, every week, every month, to obtain the highest return on investment and to properly feed the service department. Daily, parts added to inventory reports, special ordering reporting, override reporting, daily detail sales report by sales account. Weekly, inventory mix report for ASR inventories, RIM, ARO, Parts I, Nissan, ASR 20. Monthly, parts financial statement, obsolete parts report. Clue: OEM auto parts replacement systems do not eliminate the danger of obsolescence losses. Inventory turns. Emergency purchases. The typical parts manager has a tough job that is not always made easier by the sometimes cryptic bumper crop of reports that their dealer management system, DMS, has to offer. However, knowing what they tell you, along with good processes and checklists, help to keep the performance arrow pointing up. Daily reports. Special order reporting. When it comes to reports, this is perhaps the most important because of the ROI destroying impact of unsold ordered parts, SOP. When SOPs are not installed, a bona fide sale is lost, setting off a cascade of undesirable events. Unfulfilled special orders leads to wasted space in the department, forced stock, which leads to technical obsolescence, 7 to 12 months no sale, which leads to obsolete inventory. To clarify, Chuck explained that when parts have not sold in 7 months, they have an 85% probability of never being sold. For this reason, a well-thought-out special order control process and execution follow-through is critical to ensuring that they conclude in a sale. 2 valuable reports are: Report of Outstanding Special Orders by Service Advisor. This highlights the source of the problem. Is it an advisor, or the process for ensuring that SOPs get installed that the advisor works under? Report of Outstanding Special Orders by Descending Months, no receipt. Chuck notes that the critical measure for SOPs when running an aging report is what was the last time the dealer paid the manufacturer for that part rather than focusing on months no sale. When conducting your analysis of these reports, zero in on why those parts were ordered in the first place and make sure what was ordered is indeed needed. Chuck offered these examples of two reports. Parts added to inventory report. Approximately 80% of an inventory part number population has zero on hand with non-stock status. This can make analysis difficult if not broken down into chunks. Chuck recommends when building these reports include these fields: entry date, part number, description, bin, on hand, on order, value. Then regularly run the report every few days, i.e. April 12th to 14th, and find those new part numbers that show a bin location on hand and or on order quantities. And ask these questions. Why were these parts added to the inventory? Who added the part number? Where were they added? Was any demand realized for these additions? Sales override report. Why are there so many overrides? One thing is for sure, they almost always highlight system inefficiencies that waste selling time and introduce errors. Unnecessary overrides complicate management and reduce departmental effectiveness. Chuck recommends reviewing this report daily to identify trends and then addressing the underlying causes of excessive overrides. The most common causes for overrides are an unrealistic price escalator matrix and or a menu pricing issue. Chuck offered some sample reports. Daily detail sale report by profit center, sale account. Daily examination of sales and profitability is essential when reviewing pricing strategies by drilling down and looking at why gross profit might be low. 1. Customer pay repair order sales. 2. Internal sales. 3. Warranty sales. 4. Counter retail sales. 5. Wholesale sales. 6. Specialty sales, tires, accessories, GOG. This is a summary example of looking at a sales by sale account. Weekly reports. Inventory by source, stocking group. While some ASR programs discourage the practice, inventory sources can be useful for managing the parts investment. For example, if you've ever had a GL balance issue where you are high in the tire asset account and you are short in the parts asset account, the inventory source report can help figure out why. Sources enable you to group parts by attributes, such as type, accessories, gas, oil, and grease, tires, etc. Sales movement, ASR guaranteed and ASR non-guaranteed, to name a few. Inventory sources also allow for different pricing strategies, source accounting, days supply, and phase-in and phase-out criteria. If you use sources, it is essential that they be set up and maintained to ensure accuracy. The inventory by source report can be critical, based on your pricing strategy, based on your sales accounts and accounting. ASR, Automatic Stock Replenishment, Manufacturers Programs. Years back, OEMs touted auto parts replenishment as the way to reduce the dealership's reliance on parts managers, as parts stocked by the ASR programs came with a return guarantee after a period of time, often 13 months. However, this promise is not being fulfilled, forcing parts managers to be more skilled and diligent than ever so that they can adapt to the new normal. Chuck observed that the current programs fall into two groups: manufacturers programs. The governing feature of these programs is that the manufacturer controls the stocking inventory. General Motors RIM, Ford RIM, FCA Chrysler ARO, Subaru Parts I, Hyundai Parts I, Kia Parts I, Isuzu Parts I, Mitsubishi Parts I, Mazda Parts I, Nissan ASR 20, Mercedes-Benz Stock Pro, BMW SRD, Porsche ASR, Land Rover/Jaguar RIM. Traditional programs. However, these manufacturers still rely on dealers to control their own phase-in and phase-out inventory management settings. Volkswagen/Audi, Controlled Settings SSA. Toyota, Honda Acura. Under manufacturer programs, Dealers have two different inventories, one that is guaranteed and one that isn't. But it isn't always easy to know the size of each. What is the value of guaranteed OEM inventory? What is the value of non-guaranteed OEM inventory? What is the value of aftermarket inventory? Sadly, not all dealer management systems, DMS, show this data. If that is the case, then you may have to rely on the manufacturer's DCS system and/or third-party ASR to figure this out. To illustrate the impact of guaranteed inventory versus non-guaranteed inventory on dealer investment, Chuck offered this research summary of 34 GM dealers in which only 61.44% is guaranteed. Since ASR programs have limited obsolescence return features, the non-guaranteed portion can quickly get out of hand if not stringently controlled. This illustration shows what portion of the inventory that the 7 major makes guarantee. It should come as no surprise that the percentage that is guaranteed is only what sells. For example, GM generates 61.40% of the inventory, Ford 33.6%, and FCA Chrysler 51.99%. This illustration shows what portion of the inventory that the 7 major makes do not guarantee. The percentage not guaranteed and not RAM protected. For example, GM does not guarantee 38.46% of the inventory, Ford 66.4%, and FCA Chrysler 48.01%. Chuck makes the point that Ford is a bit late to the RAM game and got caught by pandemic and supply chain disruptions. He expects that the number will fall more in line with other manufacturers as conditions improve. When asked whether under today's backorder shortage environment, it would be prudent to stock more heavily until conditions improve, Chuck replied yes, because the ASR programs tend to recommend a wide breadth of stock, but not much depth. He cautioned that since only the parts recommended by the ASR program are guaranteed, consideration of the part's expected turn rate is important before bulking up. Inventory gross turns. The true turn calculation is basically irrelevant in today's parts inventory, with the exception of emergency purchases. This is because the discounts earned and obsolescence benefits from placing stock orders has largely been replaced by the RAM/ASR plans. Since gross inventory turns include the total inventory, the sweet spot is 6 to 9 annual turns. Too low suggests there is a heavy obsolete/excess inventory load weighing down on performance and ROI. However, too high can also be a problem. How high is too high of a turn rate a problem? Too high, 10-plus turns suggest that inventory breadth is not big enough to prevent stockouts, parts-related carryovers, and smooth shop throughput, all of which negatively affect parts and service ROI. Chuck added that a 40 to 50 days inventory supply rounds out the sweet spot. So how is gross inventory turns calculated? Gross turn formula. Monthly sales from stock at cost times 12 divided by inventory balance at cost. $100,000 in sales at cost times 12 equals $1,200,000 divided by $300,000 in inventory at cost at month end equals 4.0 inventory turns per year. CDK gross turn example from MGR month end summary report. Monthly net sales, $179,043 times 12 equals $2,148,516 divided by 143,960 month-end parts inventory equals 14.92 gross turns. At 14-plus turns, this may merit investigation. Dealer track gross turn example. Monthly net sales, $140,678 times 12 equals 1,688,136 divided by 311,883 months in part inventory at cost equals 5.41 gross turns. At 5-plus turns, this may merit investigation. Ray gross turns example from report code 2213. Monthly net sales, $295,320 times 12 equals 3,543,840 divided by 406,619 month ends parts at cost equals 8.71 gross turns. Looks like this is in the Goldilocks zone. Just right. Technical obsolescence and forecasting future obsolescence. Chuck reminded us that parts that have not sold in 7 months have an 85% probability of never being sold and are termed technical obsolescence. For that reason, they are worth being tracked so that they do not add to future obsolescence. The formula for technical obsolescence is divide either the 7 or 12 months sales or receipts inventory movement number, whichever is higher, by 6. In this example, Chuck divided the receipts amount 49,013 by 6 equals 8,168 monthly average aging. This is compared to how much monthly manufacturer or dealership return reserve is being accrued. The positive or negative difference is how much we'll either add or subtract from the over 12 months obsolescence. So it raises the question, am I generating enough, in this case, at least $8,168, to prevent these parts from adding to my obsolescence? It goes without saying that break even does nothing to reduce obsolescence. So what can be done? Special order control can make a big difference. Reynolds and Reynolds technical obsolescence. Reynolds and Reynolds monthly analysis. 7 to 12 month aged value, $26,682.43, divided by 6 equals $4,447.07 monthly average aging. DealerTrack technical obsolescence. DealerTrack aging analysis. 7 to 12 months aged value, $99,363, divided by 6 equals $16,560 monthly average aging. Misleading reporting. Think about sourcing. Would it make sense to put the guaranteed inventory in separate sources/stocking group for quick and easy identification? Separating the guaranteed inventory makes it easier to evaluate. Gross turns, day supply, technical obsolescence. Do you get your monthly parts financial statement from your accounting department? The parts financial statement is useful for knowing your sales, gross profit, and profit percent by profit center. Knowing your sales mix percentage by profit center. Knowing if your profit center sale accounts are reporting low grosses. Some typical reasons are that source accounting is set up improperly and/or parts are not in the right source. Conclusion. Chuck reiterated that with the rise of ASR programs, pressure is placed on parts managers to carefully manage and control the second largest dealership asset, i.e. parts. Reports, buttressed by effective processes, checklists, and follow-up are excellent tools for ensuring a high-performing parts department. He offered to answer questions free upon request.